So last chapter to knock out, finish off Allison, finish off the book. Chapter 21 is our final thing on some exchange rates. Away we go. Okay, so this is we're going to start off with kind of a little bit of a review from macro class on the balance of payments. We'll kick us off. So we have 3 ways that we keep track of international flows. It's kind of basically, I call it international accounting. So we got debits and credits, but we're not, of course, using debits and credits because that would freak me out. So we're just going to do, we'll call this international accounting. All right, so it's called balance payments, and there's 3 balance of payment accounts. This textbook kind of puts 2 of them into the financial accounts, so I'll explain that when we get to it. But so number 1 is the current account. Now, that is usually referred to exports and imports is most of it. So some people will use that a little bit interchangeably because most of the current account is exports and imports, but there's actually some other junk in there too. So when we refer to our trade deficit, it's basically exports and imports. And when we look at our cigarettes, C plus I plus G plus X, the X is net exports, exports minus imports. So this is kind of a similar concept, but it's a little bit bigger. So for the current account, we've got the value of exports minus the value of imports. So exports minus imports, we got that already now. Minus net interest paid. Net interest paid. So for our class, with all the interest rates that we're talking about, when we look at that net, it's what we paid row, the rest of the world or foreigners, minus what they paid us. Net interest paid. So this is interest income. So if you're holding a bond and it pays 5% coupon, that $50,000 coupon payment that came, that's going to fall into one of these 2 categories. So we're going to keep track of what Americans paid the rest of the world and what they paid us. And then minus net transfers. Net transfers. So that's what we give the rest of the world minus what they give us. You can imagine that for the United States, which direction that goes, we give a heck of a lot more to the rest of the world than what maybe some people give us or feed our charity. They would count for a foreigner investing or putting money into an American charity, right, or American nonprofit. So, all right, so that then gives you the current account balance. And for the United States, is that a positive sign or a negative sign? Negative, right? So we especially due to the imports here. So the note, USA is negative balance because of our, mostly due to our trade deficit. All right, number 2. Any questions on number 1? Basically, that is the same thing I gave you in Principles of Macro class. So just a little bit of review, and it's helpful to have this down before we get into speculative attacks on the central bank here. That's where we're going. So I'm sorry, let's see, I didn't want to call this capital account like we've done before. The book called it the financial account. All right, and so we're going to have foreign investment in the United States minus USA investment in the rest of the world. So I'm using rest of the world and foreign as kind of our references for out of country. And then there's going to be a little statistical discrepancy, an error term that they pretty much lump into this account. And it's usually very small relative to the whole thing, but they basically can't keep a tight set of books because, sometimes illegal money or money coming back and forth. In the financial accounts, these are all purchases of possibly stocks, bonds, bank loans, real estate, all kinds of stuff coming in for investments. And so all of that adds up to the capital account balance the way I've got this. So let's just call it financial, I'll put parentheses, capital account. And so for the United States, what's this one? Positive sign or negative sign? Remember that. Foreign investment in the United States. Positive. And so why is it positive? That's kind of the main reason I wanted to hit this first. Why is it positive for the United States? That is correct.
Because we provide some.
Let me go to Eddie. Did you say positive?
Yeah, I did, but I don't have
You don't want to go for it? Okay. Luke?
It's because that we sell so many bonds that they're technically investing in us because they're purchasing our bonds.
That's a description of what's going on, but not, I kind of want just why do we know this is positive? So what you said isn't wrong, but why do I know for sure this is positive? JC? Yeah, that's kind of describing what Luke's saying too, that we're attractive to the rest of the world or it looks good. But what's really going on is this. This result is forcing this result. If we didn't sell enough to make up for our imports, we buy more foreign crap than what they buy from us. If that's the case, who owes whom money? We owe the rest of the world some money, right? How do we pay? Well, they take IOUs. IOUs like what? Government bonds, right? There's an IOU. IOUs, corporate bonds, American denominated corporate bonds, right? American dollar denominated financial assets. Real estate. So instead of like, you don't have to pay me back, I'll buy your house in Southern California. What is it, a couple $1 million? No problem, I'll cut you a check. You don't have to pay me back for my plastic toys that I sold you over here. I'll take your house instead. Right? So that's kind of, in the grand scheme of things, that's why I call this accounting, is that debit's got to equal credits. This has to balance out. So the main chunk of what goes on with global financial flows is that we don't sell enough to the rest of the world, and they're willing to invest in us. And so it ends up working out. If that wasn't the case, then we'd see some exchange rates start to change, possibly, and we would start to sell more. American goods might start to look more attractive relative to foreign goods. Something would have to balance, right? So some prices would change if there wasn't, as JC was saying, kind of a taste for American assets. If that didn't exist, or if that starts to go away, which it could, that could be some of the changes that are forthcoming as maybe America won't look like the place to be, because gosh, if I buy American real estate now, I'm facing a 70% tax rate. All of a sudden, bye-bye. right? And so we might lose some of that foreign investment, and then some other things are going to have to shake out of that. Okay, so note for the USA, this is positive and approximately equal to the trade deficit. So we have a surplus over here. So we have a capital account surplus or financial account surplus. So you can think of it, just to put it kind of loosely, we owed the rest of the world money because they didn't want enough exports to balance out. Which is fine, by the way. I'm not saying this is a problem or anything. It's just the way things shook out. And they would rather buy foreign investments or I'm sorry, dollar-denominated financial assets and dollar-denominated real assets like real estate to balance it out instead. Okay, so then the third component is the official settlements. So official settlements. And I like to keep this one kind of set aside. Book has it in financial account. And I'm just kind of, so think of me just kind of blowing that out of what I could have put here. So I could make this 2A and B or something, but. So what this account does, we call it the official settlements because we're going to look at foreign government. We're going to treat the government a little bit different. Foreign government holdings of U.S. currency minus USA government, central bank, USA government holdings of rogue currency or foreign currency. And that then gives you the official settlements balance. All right, so the key point with all of this is all three of these have to sum to 0, and that's the accounting part. So key point, all three must sum to 0. And that's what makes it accounting. Just like in Professor Wagner's class, debits equal credits. What I sold to you is what you bought from me. The currency I had sold you is the currency you bought from me. All right, questions on that rehash? All right, so now, how does this impact foreign currency? So this chapter 21 is still on international currency, but we're really looking more at, chapter 20 was calculating private sector for the most part, buying and selling things and converting euros to dollars and all the stuff we did there. And this time we're going to be looking more like government intervention in the market. So we have an unsterilized, so let's put government intervention in foreign exchange. So I'm just going to give you up front kind of the keys to thinking about this, is that we spend a whole bunch of time in money and banking class and a whole bunch of time in this class kind of thinking about changes in the money supply. And what was the primary driver, by the way, when the Fed makes maneuvers to increase or decrease the money supply? What is the primary policy thing that they're keeping in mind? Why are they doing what they do? What's that? Lower interest rates, so affecting the interest rates. Their primary objective, though, is what? Inflation. So that's primary, and then the dual mandate is kind of where interest rates come into. So the dual mandate of the Fed is to keep inflation low, so they're targeting around 2%. It's already starting to creep up, by the way, a little bit from this COVID stuff. So if inflation is kept in check, which it basically has for the last almost 20 years, probably 15, 20 years, hasn't really been an issue, then they worry about, oh, well, what's unemployment doing? What's interest rates doing? Let's keep interest rates low, and that'll help, stimulate the economy. Kind of thinking about helping the economy, if you will, through lowering unemployment and keeping things moving along. Lower interest rates help people spend more money and invest their money, all of which I think is mostly a little bit crap. Right? So that's me personally, and as we've seen with some of the Allison books so far, does it really help long term, or does it cause a little more hurt? Is it really helpful overall? So I'm of the mindset to think that that's not really helping in the long run to keep the Fed active with policy. I would be of the mind to handcuff the Fed. And so that can be done through gold standard or through Bitcoin, perhaps in the future. My only reservation on that is that the other problem we have is that Congress and the president are too powerful. We're not really following a good federalism model of where we have power more to the states rather than at the federal level. So in some respects, I trust a little bit more my economist colleagues at the Fed than I do Trump or Biden or some of these Congress people when they pass stupid policies. Our current system allows them to make some maneuvers to offset that dumbness. But lately I've started to change my tune because I see the Fed doing some equal dumbness on their own in different cases. So I don't know where we're headed. We'll see in time. So, so the key, why I kind of give you that overview is that monetary policy has an impact on exchange rate policy. They're intertwined, they're interconnected. So the key point here is that monetary policy of a central bank is interdependent with Forex, which is the purchase and sale of currency, right? So you can see they're pretty interdependent here, depending on what they do. If you do one thing to increase the money supply, some of that money might be going to buy foreign exchange, right? So some of that money might be used to buy, used internationally, which then creates this interdependence. All right, so let's do an example here of what's called an unsterilized intervention. Unsterilized. What the heck would that mean? If you've been sterilized, if an animal's been sterilized or if something's been sterilized, what does it mean? What can it or can it do? If something's been sterile, so I'm taking unsterilized, but if something's been sterilized, what does that do to it? So it makes it, if something's been sterilized for a surgery or something, then what's happened with the instruments? Can they pass to ZDs? No. So if they're unsterilized, they can. It's potent, right? It's going to have an impact. So this first one we're going to look at, the unsterilized version, is that it's going to have some impact. So unsterilized means that the policy will have an impact on Forex, on the foreign exchange market. Okay, so let's do a purchase. For example, central bank, and I'm just going to use the Fed here, our Fed, but this of course applies to all central banks. We're going to do some examples of from Thailand and Britain in this I don't know if we can follow them today, but so the Fed purchases domestic currency. Since I'm talking about the Fed, this means dollars. And they're going to purchase it in a kind of a specific way through the sale of foreign assets. So, foreign currency. So if we took a look at the Fed's balance sheet, which would be pretty disgusting right now. Maybe we need to do that. Just get it well done. I haven't looked at it for a while. What was its assets and liabilities? So let's start with the liabilities. What are the liabilities of the Fed? The Federal Reserve now, not a bank. I'm flipping on you, going back to central bank business, kind of money banking stuff. If we did a simple little chart here, what does assets and liabilities of the Fed look like? So assets, liabilities. What's on the liability side for the Fed?
Would be reserves.
Reserves. So if they have money that's from another bank, they owe that bank money. It's not their money, right? So we have some reserves. Good. What else? What else is a liability of the Fed?
Government bonds.
Bonds. So if they're owning, they hold the government bonds, which I don't have my bonds here with me.
That's not right.
Oh, no, yeah, that's an asset. Yeah, that's be an asset, right? But what about this one? Russ McCullough owns it. So I own this 20. Does everybody agree? I just pulled this out of my wallet. So is this an asset or a liability for Russ?
Asset.
Asset. Which liability is it? The Federal Reserve. So like I could go to the Fed and say, Fed, I want $20 worth of gold. What would they tell me?
Laugh in your face.
They would laugh in my face and say, oh man, we've been off the gold standard since the 30s. We don't give you gold for this. Well, I'm like, well, what do you got to give me? And they said, flip it over. And it says on the back here, in God we trust. That's what it's worth. They might give me 2 10s or a 10 and 2 5s, but I'm not getting anything of value, of intrinsic value from the government. They gave it to me. Well, they didn't give it to me. They put it out into the society. Somebody gave it to me through trade or otherwise, but there's no backing for it, right? So that's just our quick little reminder there of why it's a liability, but it's kind of a joke because they're not going to make good on it. In fact, they're just going to kind of keep doing it unless something comes along like Bitcoin and makes them have a fixed exchange rate between the 20 and an actual amount of Bitcoin. Just like they had with gold. There was enough gold that was back. All right, so we have currency. And this is currency in circulation. Currency in circulation, and then reserves. Together, if you add currency in circulation, so outside of the bank system, remember, right? So not the stuff that's in the bank vaults. Currency in circulation, like my 20, plus reserves, equal to another variable that we talked about. Does anybody remember that one? M2? Nope, not M2. Yeah, M2 is part of it, but not. This is reserves inside and outside of banks, so that's what differentiates it from M2. I'll give you the initials. MB, monetary base. So that is the monetary base. So that's going to be talked about a little bit in this chapter too, and that's coming from the liability side here. So on the asset side, the Fed can have some bonds and other junk stuff that they might have bought from banks or something, but they also can have foreign currency. That's where we're going with this. So they bought foreign currency. They can hold that as an asset. So they can have a dollar amount or a value of euros. So they're holding 20 billion euros. So that would be an asset similar to an asset like a bond. They can sell it, right? They can sell this bond. They can sell a currency, and that would be potential for an open market operation. All right, so questions there. So let's put a little note here. So note, monetary base, the monetary base, MB, is equal to the currency in circulation plus reserves of the system. And technically, coins are in there too, but coins is such a tiny amount that we usually don't even add that on there. Okay, so now back to my example. That was just kind of starting off here. The Fed's going to purchase domestic currency through the sale of foreign assets. Does that tend to increase or decrease the money supply? So now we're back to my example. The Fed purchases domestic currency through the sale of foreign assets. Increase or decrease? See some up arrows, some down arrows.
What was your question again?
Right here, we're back to this example. The Fed is going to purchase domestic currency. They're going to purchase domestic currency. How are they going to buy it? They're going to buy it with foreign currency they have. There's going to be less dollars out there, right? So if I'm Jerome Powell, the central bank, and I buy currency, if I take it out of circulation because Brady had it for sale, I happen to have some yen, Brady's going to go to Japan, I sold my yen, so I kind of put yen into the system, into the private sector's hands, and I took Brady's dollars, right? So that was a decrease in the money supply. And then what would happen to interest rates? What would happen to interest rates?
Decrease in money supply?
Yeah, decrease in money supply. They tend to go up. And what happens to the dollar if interest rates are starting to go up, holding all other things equal? One of the shifters you had to know for your test and homework over the weekend. Interest rates go up for the United States. Dollar starts to appreciate or depreciate? Appreciate, right? Because now all of a sudden the United States looks more attractive than the rest of the world, and dollars start to flow in, causing appreciation. All right, so let me get some of that down before we get too crazy here. So from our example now, if we look at our balance sheet, so let's say Fed purchases domestic currency through the sale of foreign assets of $1 billion. Let's just add a dollar value here. So they're going to do $1 billion. And so then if we do our little T account here, assets and liabilities, we've got foreign assets going down by $1 billion. So this is the sale of foreign assets. And then we just took on liabilities. So is that a minus sign or a plus sign for the change? Remember, here's our overall balance sheet, what I started you off with here in the red. My colors going here. So now I've done this, what's the change in this upstairs going to look like? Do I have more liabilities or less?
It will have to be equal to it. If you're losing $1,000 or $1 billion in foreign currency, you'd have to be gaining $1 billion.
Okay.
In circulation.
And so, but from the assets and liabilities of the Fed then, does that currency in circulation, has that gone up or down? Down. So in terms of that little maneuver on the sheet here, we lost 1 billion of liabilities because currency in circulation fell. All right, so, yeah.
Are you saying the Fed is purchasing $1 billion worth of foreign assets?
No, they're selling the foreign assets, sale of foreign assets. So here, they're purchasing domestic currency, they're buying dollars, which is causing our currency to go down, currency in circulation to go down, and our foreign currency to go down. All right, so, let's see, that means there's a decrease, so note, that's a decrease in the money supply. And let's just put in parentheses and the monetary base. Decrease in the money supply causes an increase in interest rates domestically. We were using yesterday when we did interest, or Friday rather, when we did interest rate parity. We had the domestic country, so domestic, I'll put it here down. So interest rates go up, and that was one of our shifters from chapter 20. That leads to dollar appreciation. So from our chapter last time, we have demand, supply, we've got dollars here, and we've got the exchange rate, which is always in row currency, divided by the dollars. Basically, the Fed now is acting like the demand. They want to buy foreign currency, and so that shifts us to D2 and causes our appreciation from E1 to E2. So the dollar appreciates. So if the Fed paid with reserves, you'd end up having the same effect. So your textbook will take you through basically the same thing just to show that it's the same. I'm not going to do that in class. So you'll see that if we paid for it with a check, then reserves would change, and we'd have the same thing going on. All right, so this was all an unsterilized intervention. So how can we neuter this puppy? How can we neuter this puppy so that it's not quite as potent? What could the Fed do to sterilize it?
Print off the money.
Print off the
So to
money.
sell the currency and then print off the money. I mean, that's what I would feel like they've been doing for such. That makes sense what I'm saying. So they're
So
selling.
yeah, that would change. If we printed off the money, we could change the currency in circulation, run the printing press.
Yeah.
Okay, they don't do that.
Okay.
But you're right, that's a possibility for other governments. Other governments have been known to run the printing press. What would the Fed do? Very similar to running the printing press, they're just doing it in disguise a little bit. What would the Fed need to do? And I like Luke's answer. It's just, how does the Fed really run the printing? How did they do it for COVID?
Or no, sorry.
What did they do? Selling them or buying them? Gonna buy the bonds. So Biden puts out a big call for $2 trillion worth of bonds, and Jerome Powell says, "Sold! I'll buy them." I gotta look that up here real quick. I couldn't find it super quick, but let me just see. Fed balance sheet. Oh my gosh, it's getting worse too. I'm not going to drop the screen here, but it's right. Let's see if I can scooch this up right there. There's the Fed's balance sheet, and then they go, whoop! See that? Oh. So we kind of go from 4, and this is in millions, so this is 4 trillion to whoop, 7 trillion. And then look at it, it's going whoop, 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 all the way up to February 21st. So it's still going up.
What's that time period? That dip to that?
This from the here?
Yeah.
That was just, yeah, almost within a few weeks. So they don't have it exact, but March 11th, we're down here. March 25th. Look at, we're buying like $1 trillion a day. Isn't that fun? Look how good our government can spend money. Wow.
Last year?
Yeah, that was before, and then now it's been inching up here with more bonds. So, okay, so super fun. I was trying to see if there was an actual kind of assets and liabilities one. Yeah, not seeing a simple assets liabilities is kind of a nice way to look at it real quickly. Then plans, but that's all right. All right. So now back to the question here. Then, what's the Fed going to do? So buy bonds, right? So we're going to have an increase in bonds. When they buy bonds, what gets sterilized? What's the part that gets sterilized?
Yes. They're increasing their.
Yeah, this kind of ends up equalizing, but the money part goes away that we just did. So we just walked through money getting out into the system, but now what we're really doing is kind of this maneuver. We're switching these two around. We're going to increase our bond holdings and decrease our currency. And so that's a sterilized intervention when you offset it with government bonds. All right, so sterilized intervention. Number 2, so sterilized intervention is simply to Fed conducts an open market purchase. An open market purchase of bonds. So then if we go back to our little T account again with assets and liabilities, we've only changed the asset side of the equation. So we went up plus 1 billion in the bonds and down 1 billion in foreign currency. That's effectively, at the end of the day, what we've done with a sterilized intervention. And so does that end up affecting the monetary base? Does that end up affecting the monetary base? No. So reserves are still what they are, currency in circulation. So we have successfully neutered this thing. So the key point are therefore no change in monetary base. guess maybe more importantly, no effect on the exchange rate either, right? Because we didn't actually go do this currency swap. So no change in monetary base and no exchange rate, no e-change. Pumped out the money that would have been coming in. It stayed neutral. All right, so that brings us to kind of going over different ways that central banks operate with exchange rate regimes. So what is a fixed exchange rate regime? If a country chooses to have a fixed exchange rate, what are they doing? And yes, the name pretty much tells it like it is. Something we covered in macro class, so don't be afraid here. Daniel?
Exchange rate stays the same no matter what the monetary base.
Well, now we got to be careful. So not no matter the monetary base. I don't want to mix that in at this point. Let me go to JC. You're close. I mean, it does stay fixed. That part is good. Okay. So first of all, the central bank or the central government, sometimes they're one and the same if they don't have the independence of the Fed where they're separated, right? So if they want to have a fixed exchange rate, then that's why I brought up the official settlements balance. It's the actual government that is going to intervene in the market and either buy dollars or sell dollars to keep it fixed. And the reason that's important is that will change the monetary base, is why I wanted to, where Daniel was going with that. It will end up changing things depending on what they're doing. All right, so fixed exchange rates. Let's write that down. So central bank policy with Forex. So number one, a country can have a fixed exchange rate regime. So the value of one currency is pegged. So the word peg is what we use for this, pegged relative to the value of another. And the other currency then is called the anchored currency. Okay, so in order to pull this off then, the central bank is the one that is going to be actively intervening, buying or selling their currency to maintain its value. Otherwise, it would appreciate or depreciate, which is going to be our next system, which is what the United States does, is have a floating exchange rate. So for this one, for instance, if there was an increase in demand for dollars and the United States followed a fixed exchange rate regime, what would they need to do to keep the exchange rate fixed? JC? Sell foreign assets? So if they sold foreign assets, that's kind of what we did with this example, wasn't it? If we sold foreign currency, isn't that the one we just did? So we sold foreign currency and that led to this. So now what would we need to do? Buy it back, right? So we'd have to buy back currency. And what would we have to buy it back with? The other foreign currency, right? So they're going to be doing that maneuver that we just did with buying or selling their foreign assets to offset what would be happening in the market. So that story got a little bit skewed when I was kind of looking at this, suppose that the demand for dollars is up because they want to buy our stuff, right? Or our interest rates are up for whatever reason. And so they want to buy it, but now the central bank would have to buy it back. All right, so fixed exchange rate, one's peg, central bank must buy/sell foreign and domestic currency to keep fixed. To keep appreciation or depreciation that we went through in the previous chapter from occurring. So China right now has changed their ways a little bit. Most countries really don't follow a straight fixed exchange rate because as we're, there's some examples I'm going to show you that's blown up in their face before. And so they might have a dirty float. So number two, and maybe we'll, yeah, let me just put it as number two. So a dirty float or a managed float. I think dirty float sounds better. But and really the dirty float is what they call it. So with this type of system, the government comes up and declares that I'm going to allow the currency to float between this upper bound and lower bound, and I'll only intervene if it comes into this upper bound. But then I might change my policy too, and I'll up the upper bound if I need to. So they're kind of tinkering within certain amounts. So a dirty float is usually central bank declares a range that currency can float and then when needed or desired, or I don't know what I want to say, whenever the heck they feel like it, when needed, they can change the range. So all of a sudden the currency is hitting the upper bound and they don't like where it's going, they might come out then and change it. Okay, so then number three is the free float. So a totally floating exchange rate. So number three, a floating exchange rate regime is what we have in the United States. So the central bank does not actively intervene or pursue exchange rate changes. Central banks do not actively intervene or pursue exchange rate changes. But any sort of monetary policy, what I started you guys off with at the top of the hour, has this interdependence with exchange rates. So if we increase the supply of money, is that going to increase or decrease the value of our currency? So right now we've pumped up the money supply. So an increase in the money supply, what would that do? Depreciate. Now, let's, so let me put on here, note, central bank policy will indirectly affect exchange rates. You can't have, you can't have one and not the other. We've already studied that in the last chapter. So if the Fed pursues inflationary policy, if there's an increase in the price level, what happens to the exchange rate? Depreciates or appreciates if they create inflation? Depreciates. So that was from that equation with the real exchange rates that we did. It's also one of our shifters that we had. And then just like we started off at the top of the hour, if the Fed increases the money supply, interest rates fall, making America more attractive or less attractive for financial assets. If interest rates fall, less attractive. So American dollar denominated financial assets look less attractive, and so people don't buy as much. And so that causes depreciation. All right, so that is all of what we were talking about already. So central bank policy will indirectly affect it. It's not like they were trying to do it, but an increase in the money supply causes a decrease in interest rates that we just said. That would lead to dollar depreciation. And an increase in the money supply over the long haul would cause an increase in inflation, so price level goes up, and that causes dollar depreciation. So even though they say they're not doing it, and they're not, for monetary purposes, there was some people that were upset with some of the policies that have been pursued. Who's not liking dollar depreciation? Domestic businesses? If a domestic business doesn't do any international business, do they give a damn? No.
Importers.
Importers. Why importers?
They're importing stuff, so they're buying stuff, foreign goods, but it takes more dollars to buy that same.
Yeah, and so now it's more expensive, right? Dakota, did you have another one to add? There's a few more we could add to the list. Okay, yeah, purchasing power goes down. So we have people, what about foreign owners of dollar-denominated financial assets? What if you have a loan? Does that work to your advantage or disadvantage if the dollar depreciates? So you are Japanese. Let's go back to Brady being our Japanese example here. I don't know if you have any Japanese heritage or not, but for some reason you turned Japanese today. So Brady has some financial assets here, and he's got American financial assets. Is he happy about this when he gets his dollars back, when he needs to convert them to yen? So he has one of those Biden IOUs. He just got 50,000 American dollars. He lives in Japan. Does he use those American dollars there? No. So what does he do?
So transfer.
Converts them back to yen. And how did his return do?
No.
Right. So a lot of people were upset during, and I haven't heard it lately for COVID, but I'm sure they are. This is not going to bode well for the capital financial account that I started off the top of the hour in terms of how attractive the United States is for investing in a capital account. So we'll see how that pans out. Okay. Perfect. Yeah, maybe I'll add these two on here. I wasn't going to, but maybe we'll. No, we need to have. Let's have some fun. We got the gold. You guys got the gold standard down anyway. So let's do a speculative attack. So how could an aggressive investor hurt a country that has a fixed exchange rate regime? If you were tracking along, what's the problem that the central bank could do if they have to intervene in the markets? What's a problem that a central bank might have when its assets look like the one I gave you with our Fed, my little assets liabilities up here at the top? What could be a problem for them? Let's find out if nobody's got it.
Can you say it again?
On the foreign assets, it's okay not to have it at this point. I was just curious if anybody would, if you've identified the problem with, if you have a fixed exchange rate regime and your balance sheet looks like what I just had up here before, what was our assets? I'm pointing to where I had it erased. Maybe you think back to your notes. Bonds and foreign currency, and liabilities were reserves and currency in circulation. So what potential problem could they have if they're following a fixed exchange rate regime with a balance sheet that looks like that?
Well, assets going to be going down because they're having to sell their foreign assets.
Mm-hmm.
And then on the other side, they're having to put more currency in circulation to buy. They're putting more of their own domestic currency in.
Yeah, so, but your first part of the problem is the real problem that we're going to go in detail on. So if they need to keep the exchange rate fixed by buying dollars, they have to buy dollars in order to offset what's happening in the market. What's going to happen to their foreign currency holdings? They're going to go down. They have to sell that foreign currency. And then what's the problem? How far can they sell it? Hold that thought. That's what we're going to go over here. So, speculative attack. Speculative attack on central bank with fixed exchange rate regime. All right, so you got country A. I guess we'll call it. Give me a country name.
America.
Let's do a fake name. Very fun. Country A.
Naboo.
No, it starts with an A.
Oh.
I guess America worked, but then I wanted a fake country.
Rwanda.
Come on, be creative. What do you want? What'd you say? First one I hear, I don't care. Arwana?
Orlando.
Arwando. I don't know if I heard you totally correctly, but Arwana. That what you said, JC?
That's what he said.
All right, close enough. And then we got country B. Somebody other than JC. What is country B's name?
Bondo.
Bondo?
Bondo.
Bondo.
I thought you heard it.
All right, so we got country A, country B, Bondo. All right, so we've got, normal exchange of currency. A's get turned into B's. And so we've got the trade in between Arwana and Bondo here. And the Bank of Bondo, so Bondo's central bank here, we'll try to draw some nice big fat pillars here. This is the central bank. I'll use a green currency. So the central bank. The central bank of Bondo sits here. And when they need to intervene. And how they do that is that they hold some A currency. So in the Bank of Bondo, they have some A's. And so when they need to, they just pull out their A's and supply them to keep the exchange rate fixed. Okay, so let's kind of look at country B being a hot country versus a, so Bondo, so let's go time period 1 or step 1, time 1. Bondo is a hot country to invest in. So, if we measure Bondo currency, and we look at the exchange rate being the units of A of our WANA into Bondo, and we have a current supply and demand, I guess I'll try to do a supply with textbook code. So now I'm going to move the supply curve on this a little bit as needed. So the current exchange rate in Bondo looks like that. Bondo's a hot country though. Everybody wants a piece of Bondo. Bondo is like popping. Money roams the globe to get to Bondo. And so what's going to happen to Bondo's exchange rate if there was pressure to get a lot of investment going in Bondo? Demand goes up. So we got an increase in demand to D2, which would normally put pressure, of course, to appreciate Bondo currency. But the central bank doesn't want it to appreciate, wants to keep that hotness going. Let's keep our currency fixed. So we're going to have E1 here be the par. So we're going to hold the country at par. So that's the fixed exchange rate, is this one. And so what does the central bank of Bondo need to do with an intervention to hold the currency at E1? Increase supply. So are they supplying Bondo dollars or supplying A's? Bondo dollars, right? Yeah, because everybody wants them. And so if they increase the supply of Bondo dollars, they can do that by shifting this out to S2. And they've effectively, you could call it sterilized if you want, but basically intervened in the foreign exchange market, which was normally free market, businesses and other things are finding their country hot. And so we moved from point A to point B with that intervention.
So in reverse, let's say demand goes down after they're going to want to buy back.
Yes. Yep, and that's where we're going to get into the trouble. So time period 2, a few years goes by, and for whatever reason, Bondo's not hot. Bondo is not hot. In fact, it's cold in Bondo. Very cold. Strong recession. People are like, better get out of Bondo. Bondo's in big trouble. So Bondo starts to have some downward pressure, of course. And as that happens, what do they need to do? I think I'm just going to write this little one here. You guys got the main picture here. So A over B again. Supply, demand. Now demand is down. And we're currently at E1. And this is the par. So now what is Bondo doing? Yeah, buying back with the A currency though. So it's a very specific type of a buyback. They have to have A's to keep the ratio of A to B the same, right? So that's one thing that's pretty significant here. We've got the A and the B, and so now they're going to reduce their supply, but when they come far enough, they are selling their foreign reserves. So they are selling Arwana's currency, selling A's to maintain par. So now, if you're a hotsy-totsy hedge fund and currency trader, and you start to smell a little whiff of some trouble over here, what's the problem? Kind of circling back to my initial problem. What's the problem that Bondo could eventually run into? They don't have a supply of A's. They don't have all the A's. So if this demand curve actually goes to here, to D3,
They can't buy it.
they can't do it. So that's the fundamental problem, is that they only have a finite amount of A's to make this happen. So the key problem for Bondo Central Bank they have a finite amount of A's currency. Once they run out, what do they have to do? What is the country been wanting to do that they're not allowing to have happen? What should have happened in Bondo in a free market? Depreciation. So they've been fighting that. They've been bucking that, right? And so once they've run out of reserves, what are they going to have to do with their fixed exchange rate?
Get rid of it.
Get rid of it. Depreciate their currency, or what's called a devaluation instead of depreciation. So we use appreciation and depreciation for a market exchange rate. And when a country has a fixed exchange rate, we call it a devaluation. So they're going to have to devalue the currency. So big deal. Why is that a big deal? Who gains, who loses? So B is worth more or less? Less. That's the depreciated currency. And so who stands to gain? A's. People who own A's all of a sudden can get more B's. So it works to their, if B is depreciating, A is appreciating. So what might a good little currency speculator want to do? What would you be doing if you started to sense that Bondo Central Bank is nearing this point? What would be a profitable opportunity for you? Short B's. So what would you be doing that? How would you be doing that? Click sell. So what do you want to be forcing to have happen? If you have your own money, you could be holding American dollars, by the way, and coming to dealing with Arwanas and B's. But let's just say you're a member of the country of Arwana. And you're a fairly wealthy Arwanian. What would you want to do?
Use your A's by that way they can keep the value going up, and then you use your B's to try going back up.
I think you got a little lost on
Would
that
it
one,
be
but
your-
you're on the right track. So remember, what are we trying to have happen here? We want to drain them of their A's, right? So then what do you do?
Would it be that A would use their A's to purchase B at the low price, and then when the price of B starts to go up because all the starting to get circulating again, they would sell it and then they make profit off the difference?
Yeah, so would you want to, if you started borrowing B's, right? If you're a speculator, you could start borrowing B's, like take a loan out or use your own money to buy B's, however you want to look at it. But if you really wanted to try to make this thing happen, you could borrow B's and then convert them to A's, right? So even if you're an American, you could borrow B's, force the exchange, and hold A's. Even if you're an American and you have real American dollars here, what you're looking to have done is to break this system, right? And so once it depreciates, if you're holding A's, you're going to make some money. All right, so that is the speculative attack. So let me put that down. Let's see, I guess we'll put it here. So, speculator wants to break the bank, make it run out of reserves. And how do they do that? Well, they can borrow B's, the currency of B, borrow B's, and convert to A's at the par exchange rate, the fixed exchange rate. If Bondo Central Bank runs out, it must devalue. And now, speculator gets more B's for the A's it purchased. So, for example, if it was let's say it was 1-to-1, just to keep it easy. So, if this was 1-for-1, 1A equals 1B, and then eventually we had to depreciate so that 2 B's went for 1A. You went out and did this, you just doubled your money. Right? Once you broke the bank and they were forced to do what maybe should have been going on economically anyway, then you double your money. All right, so we'll pick up there tomorrow.